Imagine drawing water from a well using a perfectly designed bucket. But if there's a hole in the bottom, the water will drain away before you ever reach the top. In trading, that bucket is your strategy. The hole is poor risk management. You can have a high accuracy system, but without plugging that leak, your capital will eventually disappear. Over a century ago, the legendary trader Jesse Livermore realized this through a series of massive fortunes and total bankruptcies. He understood that the market has no interest in your dreams or your hard work. It simply mirrors your strengths and magnifies your weaknesses. Most traders blow their accounts because they fail to account for their own psychology. They chase breakouts because they fear missing out. They hold on to losing positions because they refuse to be wrong. And they let frustration dictate their next entry. To stop that cycle, you need the specific psychological blueprint used by elite professionals. We're going to break down the exact risk rules and mental frameworks required to protect your capital and your composure. Success requires fixing these psychological leaks before you ever open a chart. Professional trading begins before you look at a single candlestick. Every small choice you make throughout the day drains your mental battery, leading to decision fatigue. Optimizing your sleep is the highest ROI hack in trading psychology, because a well-rested mind has the willpower to stick to a plan when markets get volatile. You must also minimize external pressures. Trading objectively is impossible if you need a specific position to work out just to pay your rent or cover a mortgage. Financial perspiration will always override logic. Top traders perform an emotional audit every morning. You have to check for any baggage from yesterday's losses or a general sense of agitation. If that emotional baggage is present, the safest and most profitable trade you can make is staying out of the market entirely. Entering the market with a calm, neutral mind is the only way to ensure your decision-making remains focused on the data rather than your own needs. Once you identify a setup and go live, the best way to neutralize panic is through strict position sizing. A professional standard is to risk only 1 to 3% of your total capital on any single trade. This chart shows how a 1 to 3 risk-to-reward ratio functions. If your stop loss, the red bar, is set to lose $100, your target profit, the green bar, is set to make $300. This math creates a massive safety net. Even if you are wrong on 7 out of 10 trades, those 7 small losses equal $700, but your 3 wins bring in $900. The net result is a $200 profit, despite losing 70% of the time. Relying on this math makes it easier to follow Jesse Livermore's most brutal rule: never average down on a losing trade. If the price moves against you, do not buy more shares to lower your average entry price. Averaging down is an attempt to protect your ego. It prioritizes the need to be right over the need to protect your remaining capital. You have to cut losses quickly. Holding a losing position and hoping for a reversal is a disease that will eventually destroy your account. Treating risk as a cold mathematical formula acts as a shield, removing the emotional panic that usually accompanies a losing streak. Even with a mathematical edge, you are vulnerable while a trade is live. This is why you need hard-coded safeguards, like automated daily loss limits that lock you out of your platform once a certain threshold is hit. Ignoring these boundaries leads to tilt. This is the state where you abandon your strategy for revenge trading, desperately trying to win back what was lost, which almost always leads to a complete and utter disaster. When you feel frustration rising, treat it as a signal. It indicates a specific area where your system or discipline needs to be reviewed and studied. After the session, build a positive feedback loop by tracking your process rather than your profit. If you followed your rules, the trade was a success regardless of the financial outcome. Establishing these strict boundaries and habits turns inevitable trading losses into a controlled learning mechanism rather than a career-ending event. Success in trading is defined by consistency. While most beginners chase a single massive windfall, a professional values the ability to remain calm and analytical through every market cycle. This discipline manifests as a specific internal state, watching a position move against you without a spike in your heart rate, and closing that losing trade according to your plan without feeling anger. Once these mechanical rules of risk management become automatic, you stop fighting the charts. The market's volatility no longer dictates your mood because you have learned to manage your own internal reactions. We want to help the community grow. Drop a comment below and share the biggest psychological mistake you've made in your trading journey. Subscribe for more trading masterclasses and check the description for links to our deeper courses.